Imagine a business that was literally bleeding billions of dollars back in 2022. I mean, completely written off by Wall Street as just this pandemic-era fad, right?
Yeah.
Like destined to fail the second the hype died down.
Yeah, basically everyone thought they were done for.
Exactly. But then you fast forward 4 years, and that exact same company is printing almost $2 billion a year in pure profit. So today we're looking at a corporate evolution that is, honestly, it's just staggering. Welcome to another deep dive.
It really is a phenomenal case study in, navigating extreme market cycles. Today, we are unpacking this massive, really exhaustive financial research report on Robinhood Markets, Inc. So ticker symbol 8HOOD.
Right.
And the data we're looking at here spans from 2019 right up to the first quarter of 2026.
So our mission for this session is basically twofold. First, we need to figure out the actual mechanics of how this company transformed from a chaotic, money-losing startup into this highly profitable, financial super app.
Yeah, the operational side.
Right. And second, and probably more importantly for you listening, we are putting this stock through a brutal stress test to see if its massive surge makes it a brilliant buy right now or, a dangerous bubble for value investors.
A very necessary stress test, honestly.
Definitely. Before we jump in, though, a quick reminder. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join the deepvalues.ai app. And if you want to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
And we must establish our mandatory parameters here. So all analysis today is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment or financial decisions.
Awesome. And hey, don't forget to like this video. Much appreciated. Okay, let's unpack this. I want to take you back to 2022.
Oh boy. The crypto winter.
Yeah, the crypto winter. I mean, it was brutal across the board.
Yeah.
But looking at Robinhood's financials during that period, they were posting multi-billion-dollar gap losses. It literally looked like an engine burning pure rocket fuel just to stay idle.
That's a great way to put it, yeah.
But then the report drops us into fiscal year 2025, and suddenly that same engine is running with, terrifying efficiency. Total net revenues surged 52% to $4.5 billion for 2025.
Yeah.
And they hit a record net income of $1.9 billion.
Yeah, those numbers represent the exact moment they prove their structural profitability.
I mean, the market always wondered if Robinhood could survive without a retail trading mania, right? Without everyone stuck at home trading meme stocks.
Right, but see, I always get skeptical when I see a sudden jump from a massive loss to a $1.9 billion profit.
Sure, because it can be an illusion.
Exactly. Sometimes that is just a clever accounting trick on paper, right? Like maybe you're releasing a tax valuation allowance or selling off some core asset to juice the numbers. Well, the sources specifically highlight that 2025 was driven by top-line scaling meeting ruthless efficiency. So, no tricks. It was pure operational cash flow.
Wow, pure operations.
Yeah, and we see that momentum carrying right into the first quarter of 2026. So in Q1, they pulled in $1.07 billion in revenue, which is a 15% year-over-year growth, and locked in $346 million in net income.
That's a huge quarter.
It is. And total platform assets, which they call AUC, ballooned to $307 billion, with net deposits surging to $18 billion. I mean, that is an annualized growth rate of 22% just on fresh capital flowing into the app.
Okay, but how do you actually stop bleeding billions like that? Was this turnaround just a byproduct of the broader market recovering and people buying stocks again? Or did management fundamentally alter the DNA of the business?
I mean, the recovery definitely helped, but the fundamental shift was entirely internal. Management aggressively modulated their fixed costs to unlock something called operating leverage.
Okay, you got to break that down for me. Operating leverage is one of those terms finance people love to throw around. But what does it actually look like inside a software company?
So think of building a software platform like building a billion-dollar toll bridge.
Okay, a toll bridge.
Right. Laying the concrete, constructing the booths, hiring the initial staff, all of that is incredibly expensive. Those are your fixed costs. So in Robinhood's case, that's engineering talent, regulatory compliance infrastructure, cybersecurity.
The stuff you absolutely have to pay for just to keep the lights on.
Exactly. And during their hyper-growth phase, they were spending on those fixed costs like there was no tomorrow, literally just to keep the servers from melting down when everyone was logging in at once.
Right, but once the bridge is built.
Letting the millionth car drive across costs you absolutely nothing.
I see.
Right. The variable cost is essentially zero, so that toll goes straight to your bottom line. So when the 2022 downturn hit, management didn't just cross their fingers and hope for a market rally. They executed severe reductions in force to shrink the size of that toll bridge's overhead.
Right, the layoffs.
Yeah. And the sources write a really remarkable move in 2023. The founders, Vlad Tenev and Baiju Pot, they voluntarily canceled nearly $500 million of their own share-based compensation.
Wait, $500 million?
Yep, almost $500 million.
They just wiped their own pending paydays off the books to protect the corporate balance sheet.
Exactly. Which severely reduces shareholder dilution, right? So that keeps the value of everyone else's shares intact. You rarely see that level of capital preservation in Silicon Valley.
No, you really don't. Usually the founders get paid no matter what.
Right. And because they trimmed the overhead so aggressively during the bear market, when retail trading volume finally returned in 2024 and 2025, that new revenue fell straight through to the bottom line. It wasn't getting eaten up by bloated expenses. By Q1 2026, their adjusted EBITDA margin hit 50%.
Let me just clarify that metric for a second, because that's huge. Adjusted EBITDA basically measures the pure cash operating profit before, like, taxes and accounting depreciation get factored in.
Correct.
So a 50% margin means half of every single dollar a user gives, Robinhood flows directly through his operating cash. That is just, it's a staggering level of efficiency.
It really is.
So, okay, they fixed the engine and stopped burning cash, but you can't just cut your way to $1 billion quarter, right?
Yeah.
Eventually, you actually have to extract more cash from everyday retail traders.
Yeah.
So how are they doing that? Because the report makes it pretty clear they aren't just a simple stock trading app anymore.
No, not at all. They have engineered what the research calls a financial super app architecture. So instead of relying purely on people buying and selling stocks, their revenue is now supported by 3 distinct pillars.
Okay, what's the breakdown?
As of Q1 2026, the split is 58% transaction-based revenue, 34% net interest revenue, and 8% other revenues.
All right, let's talk about that 58% transaction bucket first, which reached $623 million. Historically, that's just standard payment for order flow, or PFOF. They route customer trades to massive market makers, and those market makers pay Robinhood a tiny fraction of a penny for the right to execute the trade.
Right, that's the classic Robinhood model. But the massive point of interest in the sources is a subcategory called other transaction revenue. It skyrocketed 320% year over year to $147 million.
Yeah, I saw that. Where is that coming from? That's a massive jump.
That exponential surge is being driven almost entirely by their new event contracts, which are essentially prediction markets where users can bet on specific outcomes, and the launch of their proprietary Rother exchange.
Oh, wow.
Yeah, so Robinhood is leveraging its massive scale, over 27 million funded customers, to instantly create liquidity pools for entirely new financial products.
It's also interesting to see them building out infrastructure for other platforms. Like, the report highlights a $14 million capital expenditure cost in Q1 to build out that Rother exchange and the backend for a new Trump accounts interface.
Yeah, that's a really interesting development.
And, I mean, regardless of politics, strictly from a business perspective, it just shows Robinhood is renting out its tech stack as a cost-plus contracted initiative. It's an entirely agnostic B2B revenue stream.
Exactly. Now, moving to the second pillar, net interest, which came in at $359 million. This proves Robinhood is functioning much more like a traditional bank now.
How so? Because when I think of interest, I think of, like, a savings account at Chase, not a trading app on my phone.
Right, but they do it in 2 ways. First, they earn interest on the uninvested cash sitting in customer accounts. So if you sell a stock and just leave the cash sitting there in the app, Robinhood deposits that aggregate cash into interest-bearing bank sweeps, and they pocket a portion of the yield.
That's
Clever. And second, and more importantly, they charge interest on their margin book, which just hit a record $17 billion.
a $17 billion margin book. So that basically means Robinhood customers have borrowed $17 billion from the company to buy more stocks than they actually have the cash for.
Yes. Easy.
And Robinhood is charging them a hefty interest rate for the privilege of doing that. I mean, that is a massive high-margin lending business.
It's extremely lucrative. And then there's the third pillar, the subscriptions. Robinhood Gold reached 4.3 million subscribers. That pushes the average revenue per user, or ARPU, up to $157.
That's a solid ARPU.
Mhm.
But let me play devil's advocate here for a second.
Wait, so-
Because brokerage accounts are notoriously easy to leave. Like, I could just hit a button and use the ACT system, which is basically like porting your phone number to a new cell carrier, to move my entire portfolio to a legacy broker in, like, a matter of days.
Sure, technically you can.
Right. So if I get mad at the interface, or, another app offers me a slightly better margin rate, I'm gone. If the barriers to exit are that low, how secure is this revenue, really?
Well, what's fascinating here is that Robinhood recognized that exact vulnerability. Over the last 3 years, they have spent immense resources building deep economic moats, specifically around behavioral and financial switching costs. They basically want to make leaving a logistical and financial nightmare.
Really? Give me an example of how they trap that capital. Like, how do they stop people from using HEKs?
Look at the Robinhood retirement product. They offer a 1% to 3% deposit match on your IRA contributions. That is literally free money upfront.
Yeah, you can't beat free money.
But the catch is structural. If you move your funds to another broker within a specific multi-year time frame, Robinhood claws that match back. Instantly, you have a hard financial penalty for leaving.
Oh, wow. Okay.
And then they cross-sell the Robinhood Gold credit card, which integrates directly into the investing app. If you want the premium cashback perks of the card, you need the Gold subscription. And if you want the 5% high yield on your uninvested cash, you have to keep the app active.
Oh, I see it. Think about your own money for a second, right? If Robinhood matches your IRA contribution by 3%, but says you lose that free money if you leave, are you really going to go through the headache of moving to a competitor?
Exactly, probably not.
You won't. They've weaponized your own convenience against you. It's an ecosystem play, just like Apple.
That's a perfect comparison.
Right. You don't just own the phone. You own the watch, the headphones, the cloud storage. By the time you want to switch to Android, it's just too painful to untangle your digital life.
They are strategically locking in the demographic that is currently undergoing the great wealth transfer, millennials and Gen Z. They acquire the user with a gamified, easy-to-use trading interface, and then anchor them down with a credit card, a high-yield savings alternative, and a retirement account.
So they've successfully trapped billions of dollars in their ecosystem, pushing their gross margins up to 94%.
Yeah, 94%.
I mean, by all logic, Wall Street should be throwing a parade. But when we actually put this stock through the deep value stress test based on its current $109 price tag, the math tells a terrifyingly different story.
It really does.
I was looking at the valuation section of the report, and it looks like it completely bombs the traditional Benjamin Graham and Peter Lynch value metrics. Why is that?
Well, we have to look at the market capitalization first.
Ah.
At $109 a share, Robinhood's total market value is roughly $98 billion. When you run that through traditional deep value filters, the warning lights just start flashing everywhere.
Okay, hit me with the numbers.
The PE ratio, so price to earnings, is sitting at 51.88. A strict value investor generally looks for a PE under 15.
Right, and just to translate that for anyone who glazes over at ratios, a PE of 51 basically means that if Robinhood's profits stay exactly where they are today, it would take you nearly 52 years just to earn back the price you paid for the stock.
Yes.
You are paying a massive premium for every single dollar of current earnings. What about the PEG ratio? Because I know Peter Lynch used that to measure price against future earnings growth.
The PEG ratio sits at 3.46. Ideally, value investors want that number under 1, which would mean the stock's price is growing in perfect tandem with its earnings. But at 3.46, the price is completely decoupled from the underlying earnings growth.
It's just flying away.
Exactly. Furthermore, the price-to-book ratio is 10.14, far above the target of 1.5. You're paying 10 times the value of the actual tangible assets sitting on Robinhood's balance sheet.
Okay, so the stock fails almost every single traditional pricing test. But the report highlights one metric that it passes with flying colors. Return on retained earnings is exploding at 105%. What does that actually mean for the business itself?
So that is a measure of internal capital compounding. It basically means for every dollar of profit management chooses to keep inside the business, rather than paying it out to shareholders as a dividend, they are generating more than $1 of additional future earnings.
Oh, that's incredibly efficient.
It proves management is highly effective at reinvesting their own cash. Add to that their pristine interest expense to operating income ratio of 0.33%, which means they have virtually zero toxic corporate debt dragging them down.
But see, here is the contradiction that is hurting my brain right now. The traditional metrics say the stock is wildly overvalued at $109. Yet the sources note that in March 2026, the board of directors authorized a massive $1.5 billion share repurchase program.
Yep, a massive buyback.
And this was right after they finished buying back $1.2 billion in shares at an average price of just $46. If the math says the stock is a bubble right now, why is management spending billions to buy it back at these high prices? Are the founders delusional?
Not delusional, but it highlights a complete evolution of Robinhood's shareholder base. Back in the depths of 2022, when the stock was trading at its all-time low of $8.14, traditional deep value investors loved Robinhood.
Well, yeah, at $8, it's a steal.
Right. At 8.14, it was trading below its tangible book value. You were literally buying billions in corporate cash and user assets for less than they were mathematically worth. It offered a massive margin of safety.
At $109, that margin of safety is completely gone.
Exactly. The baton has been passed, the deep value investors cashed out long ago, and now the stock is dominated entirely by growth and momentum investors.
So it's a different game now.
Completely different. When management authorizes a $1.5 billion buyback at these levels, they are signaling extreme conviction in their own hypergrowth trajectory. They aren't managing for value anymore, they are managing for scale.
They just assume it's going to keep sliming.
They firmly believe the cash flows they will generate 5 years from now will make today's $98 billion valuation look cheap.
Okay, so we keep saying people are paying for growth. Let's actually calculate what that future growth is worth today, because a PE ratio only really looks backward. If we are trying to find the real mathematical floor for this stock, we need to project the actual cash the business will generate over its lifetime.
And to do that, we run a discounted cash flow, or DCF, analysis. This is the ultimate mathematical reality check.
I always struggle with the assumptions in these models. It always feels a bit like financial time travel to me. Walk us through how this works specifically for Robinhood. Like, where do we even start?
Sure, so a DCF analysis asks a simple question. How much free cash will this business generate from today until the end of time? And what is that future cash worth to us right now, factoring in a 10% required rate of return?
Right.
We start with Robinhood's current owners' earnings, which represent the true cash flow available to shareholders. Right now, that sits at nearly $1.9 billion over the trailing 12 months.
Okay, so $1.9 billion is our starting line. What happens if they just, maintain this exact level of success forever? No growth, just a steady, highly profitable machine.
That is case one in the model, the no-growth scenario. If Robinhood just spits out $1.9 billion a year forever, like a perpetual bond, and we discount that back to today, the intrinsic value of the entire company is $18.9 billion.
Okay.
Divide that by the share count, and the true value is $21 per share.
Wow. And the stock is trading at 109. So a no-growth reality is completely off the table. The market clearly expects heavy expansion. What if they grow at a normal conservative pace?
Then we look at case two, the conservative scenario. We assume a 5% cash flow growth rate for the next 5 years, eventually dropping down to a 2% terminal rate to match long-term global inflation.
Seems reasonable. What's the number?
Under this model, the intrinsic value rises to $27.4 billion. That comes out to roughly $30 per share.
$30. We are still miles away from 109. Okay, let's just take the training wheels off. Give me the absolute hypergrowth scenario.
Case 3 applies a sustained 15% average cash flow growth rate for the next 5 years, followed by a 3% terminal growth rate. Sustaining 15% compounding cash flow at this scale is extremely aggressive. But even under this highly optimistic scenario, the intrinsic value of the equity calculates to $45.5 billion.
So per share, that is?
$50.54 per share.
50.54. And you're telling me the stock is trading at $109 today. Here's where it gets really interesting. It's like buying a house for double its current appraisal value just because you are absolutely convinced the neighborhood is going to gentrify over the next 10 years and they are going to build a subway station right on your corner.
That's a perfect analogy.
You are paying purely for future assumptions, not current reality.
Right. If we connect this to the bigger picture, the math is telling a very clear, uncompromising story. To mathematically justify a $109 price tag, the market is pricing in near-perfect execution.
What kind of execution?
For the DCF to reach 109, investors are expecting Robinhood to grow its free cash flow by over 25% consistently for a decade. They are pricing in the flawless execution of their international expansion into Europe, massive uncontested dominance in their new prediction markets, and explosive adoption of their credit card division.
So there is zero room for error. Like if they hit a regulatory speed bump or if the retail market cools off, that 25% growth assumption just collapses.
Yes. And for a strict value investor, this violates the cardinal rule of capital protection. Do not overpay for growth. No matter how incredible the business model is, the price you pay dictates your long-term return.
That is a brilliant distillation. So to wrap this all up, Robinhood is undeniably a success story on an operational level. They successfully shed their pandemic-era meme stock casino reputation. They built a highly profitable, sticky financial ecosystem, and they are capturing the next generation of wealth through those behavioral switching costs.
Absolutely credit where credit is due.
But the math proves unequivocally that at $109 a share, This is a momentum-driven growth equity. It is not a deep value stock. You are paying a massive premium for absolute perfection.
It is a phenomenal business, but at a very dangerous price for anyone looking for a margin of safety.
Yeah, that's the bottom line. If you want to track these kinds of metrics yourself and keep an eye on total market temperature to see when these growth bubbles might pop, remember to search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play. And to access more advanced researches, applications, and personal deep value agents, welcome to explore and join the deepvalues.ai app.
Before we close, though, I want to leave the listener with one final lingering question to mull over. We spent a lot of time talking about the financials and the operations today, but the source material highlights a really critical detail about Robinhood's corporate governance.
Oh, right, the voting structure.
Yes. The company operates under a dual-class voting structure. This structural setup gives founders Vlad Tenev and Baiju Pat roughly 60% of the total voting control, despite holding a minority of the actual economic equity.
So they hold all the cards. They have majority control over the boardroom, no matter what.
Exactly. Which means traditional activist investors cannot step in. If the stock crashes, an activist firm cannot buy up shares to force a dividend, they cannot change the board of directors, and they cannot alter the strategic direction of the company.
Wow, so you're really just along for the ride.
You are. So ask yourself this. If you buy a stock where you have absolutely no mathematical say in its future, and you are paying a massive premium for decades of required future growth, are you truly investing in a business based on fundamentals, or are you just placing a highly expensive bet on the minds of two founders?
Man, what a thought. Are you investing in the fortress, or are you just trusting the guys holding the keys? That is the question you have to answer. Thanks for joining us on this deep dive, and we'll catch you on the next one.